All right, let's talk about active trading. It's the super fast paced, high stakes world that promises these incredible gains. But, and it's a big but, it's also packed with some serious risk. So today, we're going to break down exactly what you need to know to even think about navigating these waters. So, here's the plan. First, we'll get into why people are so drawn to active trading. Then, we'll tackle the two fundamental types of risk you'll face. After that, we're going to talk about margin, that real double-edged sword. And then, we'll get practical. We'll build out a risk management playbook and finish up with the simple math you need to figure out if a trade is even worth it. So, what's the deal? Why do people jump into active trading? Honestly, it really comes down to one thing: speed. It's the chance to make quick profits, to get in and out of the market fast. That's a huge draw, and that's why people call it the market's fastest lane. But that speed, it definitely comes at a price. And that leads us right to the big question we're going to tackle today. What is it that makes active trading so darn risky? Because you can't manage risk if you don't understand it first, right? Okay, so let's make sure we're all on the same page. When we talk about day trading, what do we actually mean? Well, FINRA, that's the Financial Industry Regulatory Authority, has a pretty clear definition. It's basically buying and selling the same stock on the same day using a margin account. It's all about those super quick in and out plays. Okay, now for the main event, risk. If you want to succeed in trading, you absolutely have to understand what you can control and, just as importantly, what you can't. Yeah, so risk isn't just one big scary thing. Think of it in two buckets. First, you've got market risk. This is the big stuff, like a recession or a major interest rate change. It's like a giant wave that lifts or sinks all the boats. You can't really escape it through diversification. But then you have specific risk. This is tied to just one company or industry. Think of a company suddenly going bankrupt. Now that is something you can manage by, not putting all your eggs in one basket. All right, let's move on to a tool that, it changes everything. It's called margin. And you really have to think of it as a double-edged sword. It can make your profits absolutely huge, but it can magnify your losses just as fast. It's serious stuff. So what exactly is margin trading? The simplest way to think about it is this: you're trading with borrowed money. It's basically a loan from your brokerage that lets you buy way more stock than you could with just your own cash. It's leverage, pure and simple. And look, this isn't a free-for-all. To be officially labeled a pattern day trader by FINRA, you need to have at least $25,000 in your account. That's a pretty high bar to clear, and there's a really good reason for it. That money is supposed to act as a serious cushion against the crazy risks that come with this kind of trading. And here's where you see just how powerful that leverage is. A pattern day trader can get buying power of up to 4 times their excess margin. So let's say you have an extra $10,000 in your account. Boom. Suddenly, you can trade with $40,000 for the day. It's incredible. But you can see how this is exactly how both your wins and your losses can get supercharged. So what happens when one of those supercharged trades goes south? Well, you get what's called a margin call. It is, no joke, every trader's worst nightmare. Your account value drops below a certain level, and boom, your broker is on the line demanding more money right now. And get this last part because it's crucial. If you can't come up with the cash, they have the right to just start selling off your stocks to cover the debt, and they don't need your permission to do it. Okay, so we've talked a lot about the scary stuff, the risks. But now, let's flip the script and talk about how to deal with it. It's time to get proactive and build a solid risk management playbook, just like the pros do to protect their money. There's this great quote from Sun Tzu: "Every battle is won before it is fought." And that could not be more true for trading. The trade isn't won when you make a profit. It's won before you even click the buy button. It's won in the planning, in the strategy, and in truly understanding what you're getting into. So how do you win that battle beforehand? With these tools right here. First up, the 1% rule. This is all about survival. It just means you never risk more than 1% of your entire account on a single trade. That way, one bad move can't wipe you out. Then you have stop-loss orders. Think of this as your eject button. It's an automatic sell order that gets you out of a losing trade before it gets really bad, taking the emotion out of it. Take profit orders are the flip side. They fight greed by automatically selling when you hit your profit goal. And of course, diversification and hedging. Those are the big picture strategies that protect your whole portfolio from those specific company-level risks we mentioned. Okay, so you've done all your homework, you've got your plan. There's just one last checkpoint before you pull the trigger on any trade, and that is calculating your risk versus your reward. It's some simple math that gives you the final go or no go. The key idea here is what's called the risk to reward ratio. A really common target for traders is 1 to 3. What does that mean? It means you're aiming to make $3 for every $1 you're willing to risk. The logic here is pretty cool. If your winners are that much bigger than your losers, you can actually be wrong more often than you're right and still be profitable. Let's walk through a quick example to make this super clear. Let's say you see a stock you want to buy at $20 a share. You look at the chart and decide that if it drops to $15, you're out. That's your stop loss. And you think it could go up to $30. That's your profit target. Okay, first step, let's calculate the risk. It's just the distance between where you buy and where you sell for a loss. So your entry price of $20 minus your stop loss of $15, that's $5 per share. That's your risk. It's the maximum amount you've agreed to lose on this one trade. Simple enough, right? Now for the fun part, the potential reward. That's the difference between your target price and where you got in. So $30 minus your $20 entry price, that gives you a potential profit of $10 per share if things go right. So let's put it all together. You are risking $5 for a shot at making $10. If you simplify that down, you get a 1 to 2 risk to reward ratio. And since your potential gain is double your potential loss, yeah, a lot of traders would look at that and say, hey, that's a pretty good bet. And that really brings us to the final, and honestly, the most important question of all. We've gone through the mechanics of risk, the tools to manage it, and the math to measure it. But now you have to look in the mirror and ask yourself, what level of risk are you really, truly prepared to take on? And that's a question that nobody else can answer for you. Thank you for watching. If you got something from this, please like the video and support the channel by clicking on the subscribe button. That really helps us. Thanks again.